So in today's video, I'm going to be talking about is taking options and leveraging your position worth it? And I'm going to be going through a case study of mine with a company I've recently bought into. And if you've been following the channel, you'll know called Elf Beauty, ticker symbol ELF. And to summarize the thesis, the company was severely undervalued, 18 times forward earnings. They were probably going to beat those estimates, so about 16 times forward earnings. And the company, in my opinion, was expected to grow at least 20-30% a year for the next 5 or so years. Even analysts who were pessimistic had the company growing at least 18% a year. So either way, fast growing business, dirt cheap valuation, strong balance sheet, great management, always taking market share. So I thought there's not much to go wrong. It's highly undervalued. Let's leverage up and take some options into this position rather than just buying common stock. So what did I do? I bought some leaps, and that meant that I bought a long dated expiration contract so that I'm able to basically benefit when the price improves. So on this leap contract, it would mean that my strike price, which is the price that I can buy this company at a future date. So my future date was about 2 years from now, and the strike price was, off the top of my head, about $95. So $95. When I'd bought this contract, the company was trading at $50 and $50. So yes, quite a while off. But to me, was it worth it? Yes, it was. In terms of the investment idea itself, and the options, buying the options contract, in my opinion, not so much, and I'll go through that in a minute. So long story short, what played out? Well, actually, my thesis was correct. A lot quicker than I actually anticipated. So the reason this company fell massively was actually because of a fear around tariffs. That fear settles slightly. I mean, the business is really strong. It's a very strong brand. It's very low cost as well. So actually, yes, it would be impacted by the tariffs, but it has so much pricing power because it's so cheap for the quality product that actually, even if it raises prices fairly significantly, the business will still be fine. But anyway, the stock actually in the period of a month, I think a month and a half, goes from about $50 to just about $120. So significant, more than doubles in a month, which is almost unheard of. Now, had I just bought stock outright, I would have, bought at $45, $50, sold it at 120. Let's say I just sold it. And what that means to me is that actually I've just made a double and a bit on that investment. Pretty good, right? Now, the opposite is that, well, I could have bought an options contract, which is what I did. And then, yes, I made, so option one where I just buy stock, I made 2.2x. An option two where I buy the options contract, I actually ended up making 3.6x once all the fees and everything were done. So 3.6x compared to 2.2x, which you might think, well, David, that's actually quite good because you've just made more money betting or investing on the same thing. And to that I will say yes, of course. But do I regret doing that? I think so, yes, because effectively what I've done is I've taken out significant leverage by buying this options contract to then ultimately have a similar-ish type return. And what I mean is that, well, I'll take a 3.6x over a 2.2x any day, but what I mean is I've still made a significant amount of money in both opportunities. And actually, I would have just been better off, in my opinion, just buying more stock and then not taking on nearly enough leverage, because A, I won't have all the fees to deal with, and B, I won't have to worry about the debt. Or equally, let's face it, I mean, for a stock to go from $45, $50 to past well over $95, so more than double up, even if it's over a 2-year time span, which this contract was. That's a very tall order. It's a very big ask of the stock price as an investor, right? So your chances, what I'm getting at is, if anything, yes, this business was undervalued, and yes, it was great, but if I was wrong, like, so many things could have gone wrong, and I would have lost significant amount of some money. So what I mean is that if the company wasn't actually as good as I thought, if I didn't understand the business as well as I thought, or if I just, if something was going on internally where it's fraudulent or something I've missed off, then that would have significantly impacted the stock, and it would be very unlikely for me to hit that $95 target, meaning my options contract would be worth significantly less, probably only worth 30% of the original value, depending on how long I hold it for. If I hold it till expiration and it's worth, the stock trades at less than 95, then it will be worth literally zero. So not worth anything if anything goes wrong in that perspective. Secondly, it could have just been that, David, you were right, your thesis was correct. Management are great, the business is great, it's undervalued. But it could have just been that there was a crash. I mean, you could have bought Amazon at $5 a share or something ridiculous like that, $5-6 a share, after the dot-com bubble, when it crashed from $100 to $6. Now, was Amazon probably overvalued then? Yes, at $100 for the time anyway. But it was still a great business, so I don't see why it should have been trading at $6. Any logical person looking back would have said, actually, that was a steal. So I think you can always, just because something's cheap doesn't mean it can't get any cheaper. So that's the second thing, is you're still left with this very high risk of, well, actually, even if you're right and the business is great, the business could still be performing really well, but it could just be tariff fears keep going, or there's a crash, recession, whatever, and it wouldn't have worked out well. So that's the second risk, and it's just a timing risk. And the third thing is that it's leverage at the end of the day. So you might need that money for something else, dare something come up, and because you're leveraged, even if that position actually ended up becoming profitable in the end, because you're so leveraged, chances are that you're going to have significant ups and downs and swings. So worst case, if you needed to pull that money out, you could be at significant loss. So if any of those three things happen, more than likely you're losing 70 to 100% of your position there, which is significant. Now, I will caveat that by saying where it does make sense to have options is when you're extremely, or for me anyway, where you're extremely optimistic, you think there's a very high probability, and then you think, this is an important one for me as well, which is that no one else is pricing that in. And what I mean by that is that if the company's been very volatile, it's already shot up massively and then gone down massively, chances are that the options ladder won't be that attractive for you. So what I mean by that is that the stock would have to rise 2-3x before you make any significant return on an options contract. Whereas if it's a company that's been performing mediocrely, not previously been that volatile, and then all of a sudden one day it just goes up and off to the right significantly because your thesis has all come together, or whatever it is, right? Then that options ladder is going to be significantly more attractive. And what I mean by that is you might actually get a higher return on the second company, even though it only goes up 60% in comparison to the first company, which is priced in, and that company goes up, I don't know, 200%, let's say. So that's another thing. So if it depends on the scenario, but if it meets those criteria, chances are that it could be worth doing. If for you, again, this is my own personal criteria, if for me, I see that actually there's a significant possibility to make outsized returns, but what that also means is that it has to be outsized compared to the stock. So again, I'm going to go back to this ELF example. So had I just held the stock, had all those sort of worst case scenarios played out, recession, business isn't as good as I thought, the timing just wasn't great, it was a dot-com bubble, cheaper gets cheaper, right? Even then, I still would have held the business long term. In most of those scenarios, I would have been okay. If the management wasn't as great, yes, I probably would have taken a hit, as I and other shareholders start to realize actually this business isn't as good as we thought, and we don't really want to hold it. But I don't think there would be any possibility, there'd be the likelihood of me losing 70 to 100% is highly unlikely in comparison to if I'd used options. So I think that's a really important one for me. So it's very hard to quantify, but I think a good way that I think about it is that the risk I lose 70% using options is very high. The risk I lose 70% on stocks is quite low, or it's like if I'm going to lose 70% on options, I'm going to lose 30% on stocks. So that's sort of like the way I think about it. And so yes, I did make 3.6x, but I also had a 70% loss. Whereas yes, I could have made 2.2x, which is lower, but my loss probably only would have been like 30, 40% tops. Assuming I'm following the company and no major unforeseen event occurs. So that's generally sort of my thoughts on that. And actually, yes, I did better off financially from buying the options contract, but in that specific scenario, I think it still would have been wiser to just buy more stock, take a larger position, and feel more comfortable holding it, knowing that you've not got any leverage or anything. I mean, Warren Buffett has a great story on this where he says that he was buying shares off his friend who owned Berkshire Hathaway because his friend had been so leveraged in Berkshire Hathaway that when a great correction or depression came about, the friend had lost so much money because of that and how much leverage he had associated with it, that even though he didn't want to sell his shares, he was forced to sell them. And Warren Buffett, on the other hand, was there buying them at a steal price. So remember that cheap can always get cheaper. And if I'm going to take an options position going forward, I need to have extremely high certainty. Think there's extremely high reward, but also equally, it needs to make sense. The numbers need to make sense. So I don't want the stock to have to triple for me to make any outsized return. I want the stock to go up 80% and then I get a 5-6x off the back of that. Not so I want the leverage to really do its thing where, right, if I'm going to risk this amount, I don't want the return to be quite low and limited, because if that's the case, if I think it's a great opportunity, I'll just buy stock instead, and that's more attractive for me. It's a lot safer as well. That's generally what I'm going to be doing going forwards, and that's what I've learned from investing in Elf when I've considered and actually gone back and looked into the numbers and said, well, actually, hold on. Had I just taken a slightly larger position, I actually would have done better. And also, another thing that I think people don't talk about is that when you're in options, you're leveraged, so you really want to get out of it as soon as you can, because you don't want to risk a significant loss, particularly when time is working against you. Whereas when you're investing with stocks, time is generally your friend, and you can sit back and make a more rationalized and you can take a longer term view. So hope you found that useful. Let me know what your thoughts are on options, particularly LEAPs, longer dated options contracts. Thanks for listening. Speak to you soon.